Stock Play of the Day Overtime is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Hello and welcome to the Stock Play of the Day Overtime. On Tuesday's Stock Play of the Day, we talked about the IWM. That is an ETF that tracks the Russell 2000 index. Today we'll discuss, did we score or did we fumble? Hello, my name is Brian Overby. I am the Senior Options Analyst at Ally Invest. On Tuesday's Stock Play of the Day, we looked at a long call spread in the IWM. So that means it implies that we're a little bit bullish on that trade. I'm showing the long call spread inside the options playbook. And if I look at that at the options playbook, what we basically did was we went a little bit in the money and bought a call option. Then we went a little bit out of the money and we sold a call option. We talked a little bit about the fundamentals of the economy and how the small caps are doing, which IWM tracks a small cap index, the Russell 2000. But we were more focused on the chart. And because of that, we decided we were going to get bullish on the underlying. Now, nothing is ever meant to be a recommendation here on the Stock Play of the Day. What we're really looking for are strategies that are based off of the conditions that we see in the marketplace that might apply in your own trading overall. Okay, so we went a little bit into money and we bought strike A. We went a little bit out of the money and we sold strike B. That reduced our overall cost, reduced our overall risk of the trade. We only went out a couple of weeks in time because we're kind of hoping that the charting pattern would play out by then, more that we're doing a technical analysis trade than a pure fundamental trade. But we managed our risk by not just buying a call option to be bullish, we actually sold an option to reduce the overall cost, which also reduces our overall risk versus buying an option outright. So let's see what the stock did this week. Okay, so now what I'm showing you here is a 15-minute chart on IWM. IWM is down a little bit today. We always tape the Stock Play of the day at noon live on Tuesday. So this is a 15-minute chart, and this is noon on Tuesday. So the stock for the rest of the day was pretty much up, a little bit down and on the close. And then we had it opened up on Wednesday down and then basically went straight up so far. Our target range that we're looking at was right around the 230 level. We got as high as almost 230. It's 229.81, it looks like, is what the high was at. We probably wouldn't have sold out because, as I mentioned on the Stock Play of the Day, usually on a long call spread, you don't get paid until you get closer to the expiration date. But it was nice to know that the underlying stock actually could get to our short strike, and that's our goal, is for the underlying stock to go above that. Now we've came back down and we're hanging out right here. Now, I left this blue line on here because that's from our chart that we discussed on Tuesday's show. And so I'm going to go to the big chart, which this will be a day chart going out, I think, 5 or 6 months in time. This is what we were looking at. We had the blue line is a trend line that's been drawn that went all the way back to March of last year. There's a lot of touches in that. There's a lot of activity right in this area. We talked about a Fibonacci retracement. We broke above that. And right now we need to hold the line, right? Because if I zoom in here a little bit, which I'm going to do, you'll see that we're still holding. We're right on that trend line right now. This area of resistance, I'm going to take my cursor, I'm going to go all the way back. This is just a real interesting area on the chart just in general. See all these little touches that have happened here, all going all the way back to the beginning of this channel. And we actually have what's called, it's a positive cross where we're having the 20-day moving average. Looks like it might move through the 50-day. I don't put a lot of weight on that, but some people like to have all these lined up to be a little bit more bullish. We like the 200-day to be below the 50-day, to be below the 20-day. And overall, that's usually a good sign for the marketplace as far as moving averages are concerned. So Not always meant to be, it's nothing here that we do is meant to be a recommendation. And we don't necessarily need to do anything with this trade because, as you can see from the chart, things are still playing out. We are up a little bit on the trade, but let's get to the trade. And I'm going to give you an alternative because that's what the stock play of the day overtime is all about, are giving you some ideas on a position that you've had that is already, the stock has moved a little bit, and how I might approach it, how I might hedge it, things I might do with that trade. And first of all, whenever I'm doing a trade in general, I very rarely do more than one hedge, especially if you're doing a shorter term trade, because we really don't want to churn the account, get too many commissions on that trade overall. And you have wider bid ask spreads on options than you do on stocks. And a lot of times that makes it a little bit less convenient, if you will, to do a lot of hedges and a lot of adjustments on your trade. So here is the Ally Invest option chains. We see that we are down about 0.75%, down $1.60 on the IWM. I should probably show you that that's what we're looking at. On the left-hand side, we have the calls. Here are our expiration dates. We still have 14 days remaining in this trade. If this would have been closer to expiration when we hit that 230 level, I would have expected to just close out the trade. You would have been more profitable on it overall. So I want to know if it hits 230. I want to set an alert, let myself know if it gets to that level, because that's an important level. That's our short strike. We bought the 224 strike call, went a little bit out of the money. The underlying stock was at, 225.97 from my screenshot from last week. So right now we are up still to 27.50, even though we were doing better earlier in the week. So overall, we put this entire trade on for $3.15 on the midpoint. And right now we see it at $3.55. So you're up about 40 cents on the trade. That's still, that's a strong gain so far. The maximum that we could make overall is the maximum this could trade for, let me say, would be $5. That would be the width of that spread. So we still got a little bit of room to work. We look at the profit and loss graph as of today. This is where the underlying stock is at. We want it to get up towards that 230 level where we could close out today, make that 40 cents and move on. There's no sign right now that's implying that we should, based off of everything we talked about on Tuesday. But if you wanted to, since you're up a little bit, one thing that we can do is actually turn this into a long butterfly spread. If you want to take a little bit of the risk off the table, but still give yourself some upside, this is an alternative trade that you could look at. So how could we leg into a long butterfly spread and take a little bit of cash off the table on our paper trade that we have here? Let's go back to the option chain, and we're going to scroll back up. And the way that this would work, because in our strategy workbench here, we are buying the 224, selling the 230. So to make this a butterfly, all it is a combination of a long call spread and a short call spread. And they're using the short strike as the sale for both the long and short call spread. So that means we're going to be selling another one of the 230s. And then we go equidistant, which means in this instance, we would be 6 points out. And we would buy the 236 trade. Okay. So if I click that little arrow and I click buy, that puts the third leg of our butterfly in. Now, important to note that if I do this, if I just look at this and I was just going to sell this short spread, I would be receiving, let's call it $2, and be paying, let's call it 50 cents, right? I'm giving myself a little bit of a benefit of the doubt here. So $2 minus 50 cents, this would be $1.50 credit that you'd be bringing into the account. Now, we paid $3.15, so you'd be taking half the risk off the table, and you'd still have the same forecast. You still want the underlying to go to 230, but you don't want it to continue. By legging into the butterfly, and I'm going to go back to the options playbook, what you're doing is you have the long call spread, which looks, actually, I think I could just go back here and look at it. So here's the long call spread, which doesn't mind as the stock can go up as much as it wants. You still can make your maximum anywhere above strike B. On the long butterfly spread, this is basically the long call spread right here. If you can imagine with my cursor that I'm extending that out. But now with the long call spread, if it goes up too much on the butterfly, you're going to end up with a loss on the trade overall. So that's the trade-off. But I can bring in some capital right now. So if I look at this trade, and this would be the butterfly. The butterfly in general is a net debit of $2 to put that trade on. If I just do the spread to roll this into a butterfly, I would bring in $1.47 net credit to the account. We still have 14 days remaining. This is a viable trade. Take a little bit of the credit that you've received, take a little bit of the money off the table overall, and still have a similar forecast as you had with the long call spread. All that said, on our paper trade, it's doing fine. No reason to hedge this trade at this moment. A lot of times I like to roll into the butterfly if I'm down on a position, not necessarily up. The market has gone down a little bit. I like to do that second credit spread, or I should say that second spread, to combine it with my long call spread to take some cash off the table, but give myself still with the same forecast, a little bit of a chance to get your money back, if you will. So I prefer to do this if I'm down on a trade. Now, you wouldn't be bringing in quite as much of a credit, but that's my hedge that I like to do in long call spreads if my forecast is incorrect, but I still want to be in on the trade. Because a lot of people, if your forecast is incorrect, they just close it and they move on. They don't give themselves a chance. And once you close it, you don't have your toe in the water per se. You don't have a chip in a chair overall, right? So in that instance, this is what the alternative trade would be. And I'm going to show you down here in our profit and loss graph that this is the short call spread. This is what the alternative trade would be overall. So let me refresh this. And when you combine that with the long call spread, you end up with that butterfly. So let me go back and put the long call spread in. We'll make this 2 contracts, and we'll go back and buy the initial long option contract. Okay, so that's the way the trade would look after the fact. Oh, I must have bought the wrong one. Yep. Here we go. Sell 220. I need to just clear that out. And here's the 224 contract. That's what we started with. All right, now you see, here's where the stock is at. You still want it to go to 230 by that expiration date. But if it goes up too much, now it starts hurting you. And from 236 on up, I can lose my net debit that I have on all of the trades. But one thing is important to note, that by doing this alternative or hedge or adjustment, I guess it's not necessarily hedge, it's more of an adjustment to the trade. You're not adding additional risk. There's no more additional margin that you have to put on for the trade. Overall, you're just putting it on, bringing in a net credit, and you haven't added additional risk to the position. So there's no additional margin to do this adjustment to your long call spread. That's going to be it for this episode of the Stock Play of the Day Overtime. Please click subscribe, ring the bell, and we will see you this Tuesday for the next Stock Play of the Day. Have a great holiday weekend. Thanks for coming, everyone.